Most investors get this wrong, and it costs them everything. Every single day, someone buys an investment property without understanding one critical number. They look at the listing price. They look at the rent. They assume it's a good deal. And then 12 months later, they wonder why they're losing money. That number is the capitalization rate, the cap rate. It's the single most important metric in all of real estate investing. It tells you how hard your money is actually working. Today, I'm going to break down exactly what a cap rate is, how to calculate it, what the numbers look like across real US markets, and the 3 deadly traps that catch even experienced investors off guard. By the end, you'll never look at a property listing the same way again. A cap rate is the annual rate of return on a real estate investment, assuming you paid all cash. That last part is critical. Cap rate strips out financing entirely. No mortgage, no leverage, just pure property performance. Think of it this way. If you buy a property for $200,000 and it generates $14,000 per year in net operating income, after expenses, but before your mortgage payment, your cap rate is 7%. That 7% tells you one thing. If you paid cash, you'd earn 7% on your money every year from rental income alone. Not from appreciation, not from tax benefits, just income. Why does this matter? Because cap rate lets you compare any 2 properties on equal terms. A $150,000 duplex in Memphis, Tennessee against a $2 million apartment building in San Francisco, California. Strip out the financing, and you can see which property actually performs better as an investment. It's the great equalizer. The formula is deceptively simple. Cap rate equals net operating income divided by property value. NOI divided by value. That's it. But the devil is in the details, because most beginners get the NOI calculation wrong. Net operating income is not your gross rent. It's what's left after you subtract every operating expense. Here's the breakdown. Start with your gross potential rent. Let's say $2,400 per month. That's $28,800 per year. Subtract vacancy. Assume 8% even in strong markets. That brings you to $26,496. Now subtract operating expenses. Property taxes at $3,200, insurance at $1,800, maintenance and repairs at $2,400, property management at 10% of collected rent, $2,650, and miscellaneous expenses at $600. Total expenses, $10,650. Your NOI is $26,496 minus $10,650. That's $15,846. If the property costs $250,000, your cap rate is $15,846 divided by $250,000, 6.3%. That number now tells you exactly what this property earns stripped of all financing. One critical rule: never include mortgage payments in your NOI calculation. The mortgage is a financing decision, not a property characteristic. Different buyers will have different loans. The cap rate stays the same regardless. This is the question everyone asks, and the answer is, it depends. A 4% cap rate in San Francisco, California might be excellent. An 8% cap rate in a declining Rust Belt town might be terrible. Context is everything. But here are the general ranges. Under 4%, that's premium, low-risk markets. Manhattan, New York. San Francisco, California. You're buying safety and appreciation potential, not income. 4 to 6%, solid markets with balanced risk and return. Austin, Texas. Nashville, Tennessee. Denver, Colorado. These markets offer moderate income with strong growth prospects. 6 to 8%, income-focused markets. Indianapolis, Indiana. Memphis, Tennessee. Cleveland, Ohio. Higher current returns, but potentially less appreciation. Above 8%, high yield, higher risk. Detroit, Michigan. Jackson, Mississippi. Birmingham, Alabama. These numbers look great on paper, but they often come with higher vacancy, more maintenance, and tenant turnover costs that eat into your returns. The key insight: cap rate and risk move in opposite directions. A high cap rate means the market is pricing in more risk. A low cap rate means investors feel safe enough to accept lower returns. Let's look at real numbers across American markets, starting with the high-yield cities. Cleveland, Ohio. Average residential cap rates sit between 8 and 10%. A $120,000 duplex generating $14,400 in NOI gives you a 12% cap rate. Sounds incredible, and it can be. But Cleveland has population decline, older housing stock, and higher maintenance costs. Your actual returns might be 2 to 3 percentage points lower than the cap rate suggests. Memphis, Tennessee. Consistently one of America's strongest cap rate markets, 7 to 9% on average. Memphis has 3 advantages Cleveland doesn't. It's a major logistics hub, population is stable, and the rental market is deep. A $180,000 single family pulling $15,300 in NOI. That's an 8.5% cap rate that tends to hold up in reality. Indianapolis, Indiana. The Midwest darling of the rental investor community. 7 to 8% cap rates with steady population growth. A $200,000 property generating $15,000 NOI nets you 7.5%. What makes Indianapolis special is affordability plus job growth. Salesforce, Eli Lilly, and Anthem are all major employers keeping the rental market healthy. Now the other end of the spectrum, markets where investors accept low cap rates because they're betting on appreciation. San Francisco, California. Average cap rates hover between 3 and 4%. A $1,200,000 property might generate just $42,000 in NOI, a 3.5% cap rate. On pure income, that's worse than a savings account. But San Francisco home values have averaged 7% annual appreciation over the last 20 years. Investors aren't buying income, they're buying growth. New York City, New York. Manhattan residential cap rates average 3 to 4%. Brooklyn and Queens push 4 to 5%. A $900,000 Brooklyn apartment generating $40,500 in NOI gives you a 4.5% cap rate. Low by Midwest standards, but the property might appreciate $50,000 to $70,000 per year. Miami, Florida. Cap rates have compressed from 6% in 2019 to 4 to 5% in 2026. Driven by massive migration from high-tax states. A $500,000 condo pulling $27,500 in NOI nets 5.5%. Miami's cap rate compression actually signals investor confidence. When cap rates drop, it means buyers are willing to pay more per dollar of income. That's a vote of confidence in the market's future. How do American cap rates stack up globally? The comparison is revealing. Japan. Tokyo residential cap rates average 3.5 to 4.5%. But here's the twist. Outside Tokyo, cities like Osaka and Fukuoka push 6 to 8%. Japan's aging population means rural properties can hit 12% cap rates, but vacancy risk is enormous. Thailand. Bangkok condos yield 4 to 6% cap rates for foreigners. The catch: foreigners can't own land in Thailand, only condominiums. A 5 million baht unit, roughly $140,000, generating $8,400 in annual NOI delivers a 6% cap rate. Competitive with U.S. mid-market cities, but with currency risk attached. Portugal. The Algarve region and Lisbon suburbs offer 4 to 6% cap rates with the added benefit of the Golden Visa program. A €300,000 property generating €15,000 annually. That's a 5% cap rate, plus EU residency. Dubai, the outlier. Gross yields of 6 to 8% in a zero-income tax environment. A $1,500,000 dirham apartment, about $408,000. Pulling $28,600 in net income gives you a 7% cap rate with no tax drag. The U.S. advantage: legal protections, market depth, and dollar stability. International cap rates often look higher on paper, but carry risks that American markets simply don't. Cap rates vary dramatically by property type, and understanding why gives you an edge. Single-family rentals. Average cap rates of 5 to 8% depending on market. The advantage: they're the easiest to buy, easiest to finance, and easiest to sell. Liquidity keeps cap rates moderate. Multifamily. 2 to 4 units average 6 to 9%. Larger apartment complexes, 20-plus units, actually compress to 4 to 7% because institutional buyers drive prices up. The more units you add, the more stable the income stream, and stability means investors accept lower returns. Retail, strip malls, and standalone retail properties range from 5 to 8%. But in 2026, retail cap rates remain elevated compared to pre-pandemic levels because of the e-commerce overhang. Investors demand higher returns to compensate for the structural risk of brick-and-mortar retail. Office. This is the most disrupted sector. Office cap rates in 2026 average 7 to 10%, a dramatic increase from the 4 to 6% range before the pandemic. Remote work permanently reduced demand. Even high-quality Class A office buildings in major cities are trading at cap rates that would have been unthinkable in 2019. Industrial and logistics. The winner of the post-pandemic era. Cap rates have compressed to 4 to 6%, driven by insatiable demand from Amazon, Walmart, and last-mile delivery networks. Here's where most investors go wrong. Cap rate is powerful, but it has 3 blind spots that can cost you thousands. Trap number 1. Ignoring capital expenditures. Cap rate uses NOI, which covers normal operating expenses, but it doesn't account for the $15,000 roof replacement due in 3 years, the $8,000 HVAC system that's 18 years old, or the $12,000 foundation repair lurking beneath the surface. A property showing an 8% cap rate might effectively be a 4% cap rate once you amortize the deferred maintenance. Always request an inspection and build a capital expenditure reserve of 5 to 10% of gross rent. Trap number 2. The vacancy illusion. Most cap rate calculations assume 5 to 8% vacancy, but in some markets, actual vacancy runs 12 to 15%. If your cap rate calculation assumes 5% vacancy in a market that actually experiences 12%, your real NOI is 7% lower than projected, and your cap rate drops accordingly. Always verify actual vacancy rates for the specific neighborhood, not just the citywide average. Trap number 3. Comparing cap rates across property classes. A 6% cap rate on a 2026 built Class A apartment is not the same as a 6% cap rate on a 1960s C-class duplex. The new apartment has lower maintenance, attracts higher quality tenants, and appreciates faster. Same number, completely different investment quality. There are 3 scenarios where cap rate matters less than most investors think. Scenario 1. Value-add deals. If you're buying a property below market value with the intention of renovating and raising rents, the current cap rate is irrelevant. What matters is the cap rate after renovation. A property with a 4% going-in cap rate might become a 7% cap rate after $30,000 in upgrades. That's the forced appreciation strategy. Scenario 2. Pure appreciation plays. In markets like San Francisco, California, or Austin, Texas, investors knowingly accept 3 to 4% cap rates because they expect 5 to 8% annual appreciation. Over a 10-year hold, the total return, income plus appreciation, might exceed 12% annually. The cap rate alone tells you almost nothing about the investment quality. Scenario 3. Short-term rentals. Cap rate was designed for traditional long-term rentals. Airbnb and VRBO properties can generate 2 to 3 times the income of a long-term rental, but with higher expenses, seasonality, and regulatory risk. A property with a 5% traditional cap rate might operate at an effective 12% cap rate as a short-term rental. Different business model, different metric needed. Let me bring it all together. Cap rate is the single best starting point for evaluating any real estate investment. It strips away financing noise and shows you pure property performance. But it's a starting point, not the finish line. Here's your framework. Step 1. Calculate the cap rate using verified NOI, not the seller's numbers, your numbers. Step 2. Compare it to the market average for that specific property type in that specific location. A 6% cap rate means nothing in isolation. Step 3. Adjust for hidden risks. Add a capital expenditure reserve. Verify actual vacancy rates. Account for the property's age and condition. Step 4. Consider the full picture. Cap rate plus appreciation plus tax benefits plus leverage equals your true return on investment. The investors who consistently build wealth aren't the ones chasing the highest cap rates. They're the ones who understand what the number actually means, and more importantly, what it doesn't mean. Now you're one of them. If this breakdown helped you see cap rates differently, hit that subscribe button. We publish 2 new data-driven real estate analyses every single week. Next up, we're breaking down the exact markets where cap rates are compressing the fastest in 2026 and what that signals for investors. Drop a comment telling me, what cap rate are you targeting for your next investment? I read every single one.